From the day you got your first job, you have been fed a massive financial lie. Financial advisors, HR departments, and the government all told you the exact same thing. Put your money in a traditional 401k, get the tax break today, and you will be safe when you retire. It sounds like great advice, but it is actually one of the most dangerous financial traps in the American tax code. Millions of hard-working Americans are shoveling a percentage of their paycheck into a traditional 401k or IRA every single month. They think they are building independent wealth, but if you actually read the tax code, you realize what a traditional 401k really is. It is a joint bank account with the Internal Revenue Service, and the IRS gets to decide their share after you do the work. They let you take all the market risk. They let you do all the hard work of saving, investing, and stressing for 40 years. And then, right when you are ready to retire and enjoy your money, the government changes the rules of the game. They use hidden formulas to take a massive cut of your life savings. Today, I am going to expose exactly how this retirement trap works. I am going to show you how the government uses 401ks to force the middle class into paying higher taxes in retirement. I will expose a quiet law passed recently that allows the IRS to seize up to half of your children's inheritance. And if you stay until the end, I am going to reveal the tax-free cheat codes the wealthy use. Instead, stop playing a game where the IRS holds the cards. Let's open the rulebook. Trap number 1 is the great tax bracket myth. For decades, the financial industry has sold you on one core concept. They say you should defer your taxes today because when you retire, you will be in a lower tax bracket. You won't be working anymore, so your income will be lower and you will pay less to the IRS. This is mathematically and historically false. First of all, look at the history of U.S. tax rates. We are currently living in one of the lowest tax rate environments in American history. We have a massive multi-trillion-dollar national debt. Medicare and Social Security are heavily underfunded. Do you honestly believe that 10, 20, or 30 years from now the federal government is going to lower income tax rates? Taxes are almost mathematically guaranteed to go up in the future to pay for the national debt. By putting all your money into a traditional 401k, you are making a bet that tax rates will be lower in the future. You are taking a deduction today when taxes are on sale, only to pay the taxes later when rates will likely be much higher. But that is only the first part of the trap. The second part is that the government does not actually let you control your own income in retirement. They force you to take money out of your 401k whether you want to or not. This is called a required minimum distribution or RMD under current law. Once you reach age 73, the IRS looks at your traditional retirement accounts and says, "Playtime is over. We want our tax money." The IRS uses a life expectancy factor to force you to withdraw a specific percentage of your traditional 401k or IRA every single year, and every dollar you are forced to withdraw is taxed as ordinary income. You might be living a modest lifestyle. You might not need that extra money. It does not matter if you do not take the exact RMD amount. The IRS hits you with a massive penalty. It used to be a 50% penalty on the amount you didn't withdraw. Now it is 25%. It is one of the harshest penalties in the entire tax code. So you are forced to pull this money out and claim it as income. This completely destroys the myth that you will be in a lower tax bracket because you have been a good saver. These forced withdrawals pile on top of your other income streams. This forced income creates a devastating domino effect that financial advisors call the tax torpedo. This is trap number 2. Let me explain exactly how the tax torpedo destroys your wealth. Most people believe their Social Security benefits are completely tax-free. They are not. Whether your Social Security is taxed depends on a formula the IRS calls your provisional income. If your income is very low, your Social Security is tax-free. But if your income crosses a certain line, the government taxes up to 85% of your Social Security benefits. Now picture what happens at age 73. You are happily collecting your Social Security. Then the IRS forces you to take a massive required minimum distribution from your 401k. That RMD counts as ordinary income. Suddenly, that forced 401k withdrawal artificially spikes your provisional income. Because your income just spiked, it triggers the Social Security tax trap. Now up to 85% of your Social Security benefits are being taxed. You are paying taxes on your 401k withdrawal, and that withdrawal is causing your Social Security to be taxed. It is a double taxation nightmare. But the tax torpedo does not stop there. It hits you a third time, right in your healthcare. Medicare premiums for Part B and Part D are based on your income. If your income goes over a certain threshold, the government hits you with a massive surcharge called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a hidden tax disguised as a healthcare premium. When the IRS forces you to take that RMD from your traditional 401k, it raises your adjusted gross income. That forced income pushes you right over the IRMAA threshold. Suddenly, your Medicare premiums skyrocket. The government forces you to take your own money out of your own account, and as a punishment they tax your Social Security and they jack up your healthcare costs. This is why the traditional 401k is a trap. It gives the government total control over your tax bracket in your final years. You thought you were saving for your future, but you were actually building a taxable slush fund for the IRS. But it gets even worse. What happens if you don't spend all the money? What if you want to leave that hard-earned 401k to your children? This brings us to trap number 3, the Secure Act inheritance trap. For decades, one of the greatest wealth-building tools in America was something called the stretch IRA. If you died and left a traditional IRA or 401k to your child, they did not have to pay taxes on it all at once. They could slowly stretch the required withdrawals over their entire lifetime. This allowed the money to keep growing tax-deferred for decades, and it kept your child's tax bill very low. It was a brilliant way to pass down generational wealth, but the government hated it because it meant they had to wait too long to get their tax money. So in 2019, Congress quietly passed a law called the Secure Act, and with the stroke of a pen, they killed the stretch IRA. Under the new Secure Act rules, if you leave a traditional 401k or IRA to your adult child, they are no longer allowed to stretch the withdrawals over their lifetime. Instead, the government forces them to completely drain the entire account within exactly 10 years of your death. This is called the 10-year rule, and it is an absolute financial catastrophe for your heirs. Let me break down the math on why this is so devastating. When do most people pass away and leave an inheritance? Usually when they are in their 80s or 90 seconds. That means their children are usually in their 50s or 60 seconds when they inherit the money. What happens during your 50s and 60 seconds? Those are your peak earning years. Your child is already making the highest salary of their career. They are already sitting in a high tax bracket. Now, because of the Secure Act, the government forces them to take massive taxable withdrawals from your inherited 401k on top of their peak salary. If you leave a $500,000 traditional IRA to your daughter, she has to pull out roughly $50,000 a year. Every year for 10 years, that gets added directly to her taxable income. This forced withdrawal pushes her into the highest possible federal and state tax brackets. By the time the 10 years are up, the IRS and the state government might have taken 30 to 50% of the entire account. You spent 40 years skipping vacations and eating leftovers to save that money, and the IRS swoops in and takes half of it from your grieving children. That is the reality of the traditional 401k. It is a tax time bomb that explodes on you in retirement and then explodes a second time on your children when you die. So how do we fix it? If the traditional retirement system is a trap designed by the government, what do the wealthy do instead? The wealthy do not blindly follow HR department advice. They use the tax code as a menu. Here are the tax-free cheat codes the wealthy use to escape the IRS cheat code. Number 1 is the Roth Conversion Ladder. The ultimate goal of generational wealth is to get your money into an environment where the IRS can never touch it again. That environment is the Roth IRA. Unlike a traditional account, money in a Roth IRA grows completely tax-free forever. When you pull money out of a Roth IRA in retirement, you pay zero federal income tax. Because the money comes out tax-free, it does not count toward your provisional income. This means it does not trigger the tax on your Social Security, and it does not trigger the Medicare IRMAA surcharges. It completely disarms the tax torpedo. But here is the most powerful part of the Roth. Roth IRAs do not have required minimum distributions. The government cannot force you to pull your money out at age 73. You can leave it in there to grow tax-free for the rest of your life. and when you pass away you can leave that Roth IRA to your children. Yes, the 10-year rule still applies to them, but because it is a Roth, every single dollar they withdraw is 100% tax-free. The IRS doesn't get a single dime of your child's inheritance. So how do you get your money out of the traditional 401k trap and into the tax-free Roth haven? You use a Roth Conversion Ladder. You do not convert all your money at once because that would cause a massive tax bill. Instead, you wait for years where your income naturally dips. For example, the window right after you retire, but before you start collecting Social Security. During those low-income years, you calculate exactly how much room you have left in the low tax brackets. Then you intentionally move that exact amount from your traditional IRA into your Roth IRA. You pay a very small calculated amount of tax today on the seed. But once that money is in the Roth, the harvest grows completely tax-free forever. You convert a small chunk every single year, systematically draining your taxable IRA and filling up your tax-free Roth IRA. By the time you reach age 73, your traditional accounts are empty. The government tries to force RMD, but there is nothing left to take. You beat the system legally. Cheat code number 2 is the Mega Backdoor Roth. The government places strict limits on how much money you can directly contribute to a Roth IRA every year. For most people it's around $7,000 or $8,000, but the wealthy use a completely legal loophole called the Mega Backdoor Roth to pump tens of thousands of dollars into a tax-free account every single year. Here is how it works. Many modern employer 401k plans allow you to make what are called after-tax non-Roth contributions. This is totally separate from your regular traditional or Roth 401k limits. The IRS allows total plan contributions of up to around $69,000 a year. If your employer allows it, you can fill up that massive bucket with after-tax money. Then you immediately execute an in-service rollover. You take that massive pile of after-tax money and immediately convert it into a Roth IRA or a Roth 401k. Because you already paid taxes on the seed money, the conversion costs you nothing. You just legally bypassed the normal contribution limits and dumped massive amounts of capital into a tax-free growth shelter. This strategy is fully legal. The IRS has published guidance explicitly allowing it. It is one of the quietest and most powerful advantages in the entire tax code, but it only exists for the people who actually bother to ask their HR department or plan administrator if it is available. If your plan offers it, it can supercharge your tax-free wealth by hundreds of thousands of dollars. Cheat code number 3 is the absolute crown jewel of the American tax system. It is the Health Savings Account, or SHA. Most people think SHA is just a temporary account to help pay for a doctor's visit or a prescription. That is a massive mistake. The wealthy do not use SHAs to pay for current medical bills. They use them as a secret, high-powered retirement account. The SHA is the only account in the entire United States tax code that gives you a triple tax advantage. Benefit number 1, the money you put into SHA is completely tax deductible. It lowers your taxable income today, just like a traditional 401k. Benefit number 2, the money inside the SHA can be invested in the stock market and it grows completely tax-free. Benefit number 3, when you withdraw the money to pay for qualified medical expenses, the withdrawal is 100% tax-free. There is literally no other account in the tax code that gives you all 3 of those benefits at the same time. A traditional 401k taxes you on the way out. A Roth IRA taxes you on the way in. The SHA never taxes you at all. It is a ghost to the IRS. But here is the twist that makes the SHA the ultimate wealthy cheat code. Almost nobody reads the fine print on this rule. There is absolutely no time limit on when you have to reimburse yourself for a medical expense. Let me repeat that. There is no time limit. You do not have to withdraw the money from your SHA in the same year you incur the medical bill. Here is what a smart investor does. They max out their SHA contributions every single year and invest the money in an S&P 500 index fund. Then when they go to the doctor or buy glasses or get dental work done, they do not touch the SHA. They pay for those medical expenses completely out of pocket using their regular checking account, but they save every single receipt. They put those receipts in a digital folder and let the SHA money stay in the market, compounding tax-free for 20 or 30 years. Then, when they are 65 years old and want to buy a boat or take a luxury vacation, they open that folder. They add up 30 years of old medical receipts. Let's say it totals $50,000. They call the SHA administrator and say, "I would like to reimburse myself for $50,000 of past medical expenses." The SHA administrator wires them $50,000, completely tax-free. It does not matter that the medical bills were from 2 decades ago. The tax code allows it. The SHA functions as a secret, tax-free vault that compounds over your entire working life. And what if you get to age 65 and you never had enough medical expenses to drain the account? The IRS thought of that too. Once you turn 65, the rules for SHA magically change. You can withdraw money from your SHA for non-medical reasons and you will not pay a penalty. It just gets taxed as ordinary income, exactly like a traditional 401k. So in the worst-case scenario, your SHA acts exactly like a traditional retirement account. But in the best-case scenario, it is a completely tax-free vault that the IRS can never touch. It is the ultimate financial no-brainer. The system was built by people who expected you to learn the rules, find the incentives, and build wealth, using the tools they provided. The reason most Americans fall into the 401k trap is not because they are not smart enough. It is because nobody ever tells them the truth about how the tax system actually works. Your high school did not teach you this. Your college did not teach you this. Your employer certainly didn't teach you this. Most financial advisors are trained to sell you products, not strategies. So the tax code sits there, full of flashing green lights and exit doors, waiting for someone to read the instructions. Congress uses the tax code to steer money. The wealthy read the instructions, order off the menu, and pay 0%. The middle class trusts the default advice, puts all their money in a taxable bucket, and lets the government take half of their kids' inheritance. You do not have to be a victim of the tax code. You just have to stop playing defense. If you have all your money locked in a traditional 401k, sit down with a certified tax professional or a fiduciary advisor this year. Ask them to run the math on a Roth conversion strategy. Ask them what your required minimum distributions will look like when you turn 73. Ask them how the Secure Act will impact the money you plan to leave to your children. Run the numbers on opening a health savings account and keeping your receipts. The math will shock you. The difference between leaving your money in the traditional trap versus strategically moving it to tax-free shelters is often measured in hundreds of thousands of dollars over a lifetime. Generational wealth is not built by working harder. It is built by positioning your assets inside the parts of the tax code that the government subsidizes. You have the information now. The only thing left is to take action. Do not wait until you are 73 years old to realize the government is forcing you to liquidate your life savings. Protect your wealth today. Do me a favor before you go. Millions of hard-working people are blindly shoveling their paychecks into traditional retirement accounts right now, completely unaware of the tax torpedo awaiting them. They don't know about the REM trap, they don't know about the Secure Act inheritance wipeout, and they don't know the unbelievable power of a health savings account. Send this video to one person in your life who needs to hear the truth. Send it to your aging parents so they can protect their wealth. Send it to your adult children so they can start building their Roth accounts the right way. One single text message from you could literally save your family's financial future and keep hundreds of thousands of dollars out of the hands of the IRS. Hit the like button right now so the YouTube algorithm knows this information is valuable, and it pushes this warning to more people who are searching for the truth. Make the decision today to stop playing the government's game. Subscribe to Unredacted Finance, protect your wealth from the system, and I will see you in the next one.